Joining us today is Jeremy Bickler, CLU, Vice President at Simplicity Life. With over 20 years in insurance and finance, he's a driving force behind the Kaizen strategy, making it easier for clients to grow, protect, and transfer their wealth. Jeremy, welcome to the Compass Conversation.
Thank you, Brandon. Thank you for having me.
So how are you today? Everything good over there?
Yeah, doing very well. It's full-blown summer up here in Minnesota.
So what drew you to the NIW and the Kaizen strategy?
So I go back, 15 years with NIW as an organization, back when I worked at an IMO, back when I owned an IMO. And when it came to leverage life insurance strategies in general, I wanted to offset that risk or farm that out and bring on a partner that specifically did that brought banks in, that did the designs rather than staffing up for that and taking on that risk myself. So I was introduced to the folks at NIW about 15 years ago. So I had been using all of their strategies. And of course, 11, 12 years ago, I started using Kaizen as a strategy. So it really lent itself to more of a business partnership initially that flowed in through utilizing Kaizen.
So when we're talking about Kaizen, because most people might not know what it is, can you describe what kind of strategy it actually is? Because I know it, for me, I know it's based around life insurance, but you've been doing it you've been doing it over 15 years. So can you give us the breakdown of really what the strategy is?
Yeah. So at its foundation, Brendan, it is a max funded life insurance plan. There is an acronym out there in the insurance world called LIRP, or Life Insurance Retirement Planning, which has been around for decades. What Kaizen does, though, is take that LIRP strategy and in a responsible way, add leverage dollars on top of that while still protecting or siloing the client from that loan. So you can experience the benefits of leveraging increased capital into the plan without having an outstanding loan on your balance sheet, without having to post collateral. Going into it, you are just going to pay X amount for 5 years. So it's almost a hybrid strategy as opposed to what the industry would be called or would be calling it traditional premium financing, because the client's not on that loan. So think of it as injecting other people's money, capital, into a tried and true strategy that's been around for 40 plus years.
So when we're using the word leverage, right?
Yeah.
We're talking about using other people's money or the bank's money to help fund your life insurance policy, right? In the simplest of terms?
Right. That's exactly right. The one caveat that is important and makes it different in all of those other strategies out there, which have also been out there for years, the client, just like when you buy a car or when you purchase a home, you're signing loan documents, personal guarantees. If there's a shortage in the cash value of the policy, you're posting a liquid asset or collateral in the form of a liquid asset. All of that goes out the window with Kaizen. Your client is not the one borrowing the money, which makes it unique in that realm.
So the client is responsible for a portion or 25% of the actual dollars going into the life insurance policy. And then the bank is responsible for the rest of the 75%. Is that correct?
Exactly. So a typical design would be the client's paying roughly 50% of the premiums years 1 through 5. The bank funds the other part. And then at the end of that 5th year, you are done. Your out-of-pocket obligation is done, and the bank is funding all of the premiums years 6 through 10. And that's where that 3-to-1 leveraging comes into play.
So what happens after that? You're done funding after 5 years. The money's completely being funded by the bank. How long do we have to wait to take some money out? How long to the bank gets their money back? How does that, how does that work for clients that are looking to use this strategy?
Yep. Excellent question. So always 5 planned payments with the client, and then that 3-to-1 leveraging on top of that by the bank for the next, over the 10 years. Mm-hmm. First, after the 5th year, there cannot be any more out-of-pocket obligations. You're completely funded. What we do need to do, though, is we need to let these things grow and cook. Since we're utilizing leveraging dollars and those dollars are going in, if I oversimplify leveraging is I want the return on the money to be higher than the cost of the money. Right. So we're going to give it some time to cook. So the expectation, Brendan, is 15 years.
Okay.
So now, important caveat though, is that does not mean if there's emergency, you need to quit and walk away. You can do that at any time, of course. But as far as taking withdrawals and a planned income stream, the 15 years should be the expectation that is set there.
So it is a long-term investment, right? You're
yes.
investing in life insurance and with the bank. So it is a long-term investment. But there are outs if, God forbid, you needed to get something
exactly.
happen.
So number one, it is life insurance at the end of the day. So should something happen to you, of course, there is actually going to be more death benefit to your beneficiaries because of the leveraged dollars. But from I just need to walk away from this, or any prospective financial hardship or liquidity concern, you can quit and get your money out once you can pay the bank back early. That can be done certainly at any time.
Mm-hmm.
But from an income stream, we're planning 15 years.
So how does Kaizen manage risk differently than other leveraged insurance strategies if we weren't to look at it that way?
Great question. It's really about specifically the design in terms of the relationship between how much your client is putting in and how much we are leveraging. I mentioned a bit earlier that the client is funding roughly, depending on age, 50% of the premiums years 1 through 5. Mm-hmm. That will look different for everybody, Brendan, based on your age, based on your rate class, et cetera. So what we're doing is we're stress testing every design based on the two worst 15-year histories the U.S. economy has ever seen. High interest rates in the 1980s and underperformance of the stock market from 1930 to 45, Great Depression. Mm-hmm. We start with that underperformance. So we're not trying to make things look great on paper or overpromise. We start with those two stress tests, and those stress tests are what dictates how much we can or cannot borrow based on that client's age. Every Kaizen design has to do that, and that's what makes it unique. Where other platforms, you may just be borrowing 90+% of the premiums, and the client may just be paying interest on the bank loan. I don't want to say there's anything, quote, wrong with that, but it is a significantly different risk. You may have liquidity issues and collateral needs for 10, 12 plus years on that. So that's the fundamental difference is we're leveraging smaller amounts based on a stress tested amount to ensure that your client never is on the hook for the bank loan. They're not signing those typical loan documents.
So when people hear leverage, they think about debt, right? So you're saying that they're not on the hook for those bank loans. So it's not debt. They're just helping you fund the life insurance. They're going to get their money one way or the other, the bank, because they're either going to take from the cash value at year 15, which we mentioned earlier, or God forbid something happens to you, they're going to get it out of the death benefit, correct?
Exactly. This is not on your client, on the balance sheet. It's not credit checks. It's not showing up. The policy itself has a collateral assignment on it for the amount of the bank loan, but the policy is still, for all intents and purposes, owned by the client. But the loan itself is not on the client's balance sheet. It's not on their credit checks. They didn't sign a personal guarantee for it.
I was like, okay, so you're taking it's not on your balance sheet, but there are interest rates involved with the loan, right? So how does Kaizen, the strategy, go to the banks? Do they review these rates every year? Or are they looking for better rates every year? Or how does that work?
Great question. Yes, there's no shortage of lenders that are participating in this because it's essentially a secured loan to the bank because the IUL has a 0% floor. And we're leveraging much less than typical traditional financing from that standpoint. So typically what you will see is a bank rate plus a spread. Like there's an acronym in the lending world called SOFR, Secured Overnight Funding Rate. So it's usually SOFR plus a spread, and those are 1-year rates that renew annually. So when your annual review comes, you will know what the rate is going into next year. But please know, These are $1 million+ tranches that we are constantly searching. And if we can refinance and get a better rate in year 3 or year 5, we'll certainly do that. As a matter of fact, when we had those Fed rate increases a couple of years back here, we refunded 5 tranches that year and
Wow.
got clients better rates on those loans because, again, there's no shortage of lenders.
And just because you use the term tranches, you're buying, you're going to the bank and you're tranching hundreds of millions of dollars for these loans, right? For the loans. It's not just you're doing one. So if somebody puts in like, hey, we want to do $100,000, we're putting in 34% of the 100, we're putting $134,000, the bank's putting in the rest. You're buying these in hundreds of millions of dollar tranches, correct?
Yeah, it's exactly great point. So for example, I'm a Kaizen owner myself. So my policy was funded on the same day as, let's say, 100, 200 other policies. So rather than going to the bank and trying to borrow 35 grand or 50 grand, there's no enterprise pricing in that. And sometimes there can be breakage fees with small loans. So what we'll do is we'll actually go to one bank and do one loan. So there may be millions of dollars that is funded. So because of that, we're borrowing at lower than what would typically be deemed street pricing. And like you had accurately stated, Brendan, there's a significant savings with that because these are millions of dollars as opposed to $30,000 or $50,000. Great point.
Okay, thank you. And then that's a great explanation of that question. So when we're looking at this, when we're talking to clients, where do you see this fitting in as a strategy for someone? What are the best clients? Is there an age range, typical type of client that you want to talk to about it? Because when I bring this up, when I brought this up at seminars, I talk, we can get into the wealth transfer part of it in a little bit, but most of the clients that are in their 60s and 70s are looking like, oh, we can do that for who and who does this fit? But can you give me the best definition of where this fits in for a client basis?
Absolutely. So we'll start with the age range that are actually approved. So ages 18 to 65. So adults up to 65. But the wheelhouse, Brendan, that we see far and away most is ages 35 to 55.
Okay.
Of course, if you're younger, all the more it looks better and the IRRs get more phenomenal, but we don't always see the discretionary income in a younger client for the minimum premium. So, and then as we get older, like you mentioned, if you have clients in their 60s, remember there's a 15-year wait that we talked about earlier. So it's not always feasible to wait 15 years for an income stream. So that's why typically the 35 to 55 from an age range. Now, from a financial perspective, we're talking household income of around 200,000 or higher is very typical from what we're seeing. It's generally speaking clients that have discretionary income. Maybe they've maxed out their qualified contributions and they're just flat out concerned about taxes. Clients that would typically invest in a Roth type of thing where I'm concerned about taxes down the road and how much of my income may be taxable. This would be an excellent strategy for that.
Some of the people that we've used it for are doctors, lawyers. They're in their prime, 33 to 55. They're making money. Their loans are paid off, and they've capped out, like you said, 401k IRAs. Their Roth contributions have been made if they're able to do that, and they're just looking for other vehicles to put money away. And they like the fact that they only have to pay for those 5 years, and that somebody else is going to help put them in for that, and then, God forbid, if there's any wealth transfer later on, you're passing down those assets to their kids.
Absolutely. Because at the end of the day, it still is life insurance and we're buying more life insurance because of the leveraging. So while the primary objective may be a tax advantage income stream, you're still having that added wealth transfer for your beneficiaries should something happen to you.
So if we're talking about wealth transfer, right? We're talking about people that are in, we have baby boomers that are hitting 80 years old this year, right? They're there. They have most of their money are in qualified dollars. How can we use a wealth transfer, and how does Kaizen help families pass down legacies across the board?
Yeah, there is actually a specific platform where we're utilizing gifting. So let's use a scenario, for example, where we'll call it generation one, Brendan. Generation one is in their 60s, maybe even, 70. What would generally be considered too old for Kaizen, but they have adult children, and they're talking about gifting. So they could gift the Kaizen premiums to their adult children, still experience the leveraging. So now what you're doing is you, instead of just transferring straight non-qualified assets, you're putting them in a plan that is going to have tax-deferred growth, leverage dollars on top of that, income tax-free income, and potential tax-free distributions. So if we're talking about maximizing a gift and transferring of wealth, utilizing those premiums plus the leveraging is an excellent strategy for families that are planning on gifting or are currently gifting to their adult children.
And then what are some of the long-term outcomes that clients can realistically expect with Kaizen in terms of tax-free income or legacy planning, right? That's what we're talking about. When parents are gifting dollars to their adult kids, that's legacy planning. But what are the outcomes could be income-wise when then those children decide to retire?
Yeah, so if we would compare it to, let's say we compare it to the exact same plan, the exact same carrier, the exact same product, but no leveraging or no Kaizen. The Kaizen plan typically, depending on your age and how long it defers, can get you anywhere from, we're seeing 60 to 100% more income than if you just funded it on your own with no Kaizen. And that added death benefit we're seeing is sometimes double day one than what you would be if you were just, again, funding it on your own.
So if I do a traditional index universal life, whole life, I'm funding that, and I want to take income from that policy. It's from whatever the cash value is. But you're saying when we're looking at it in a Kaizen strategy, we're looking to 60 to 100% more or double the income that you could take from your life insurance, which is completely tax-free when you're taking it out, if you take it out properly.
Section 7702 of the tax plan is specifically structured life insurance plans. When you're taking loans, they are tax-free. And as a matter of fact, Brendan, page 4 of the Kaizen design that they can talk to you about, and you can show them on the design, will actually compare that and call out those numbers based on if you were doing this in the exact same product, exact same insurance partner with no Kaizen. So we show that to you on every design.
And I've seen those designs. I like the strategy because it shows you the piggy bank example of literally in simplistic terms, in a simplistic picture, it gives you that example of how it is, right? So can you use Kaizen in business settings? Could you use it for key person insurance instead of just buying a buy sell or a term or?
Absolutely. As a matter of fact, it is a large portion of the Kaizens are utilized by small businesses and or small business owners. A couple different ways. So first I'll bring up what is an executive bonus, a retain reward scenario.
Okay.
So let's say, Brendan, I'm one of your key employees, and you're concerned about me being headhunted or me, one of your competitors stealing from me. So what you could say is, Jeremy, I will bonus you $25,000 for the next 5 years. It's taxable to me as payroll or salary. It's a write-off for you, the business owner, as payroll expense. Why do I love it? Number one, it's going into a life insurance plan that I own. I name my beneficiaries. But when you add Kaizen now, we turbocharged and we got 3 times the capital going into it because of the leveraging. That's significant rather than me waiting around for December or January for a year-end bonus from you just to then go walk away. Now I have some added incentive because it's like, who's going to fund my Kaizen if I leave Brendan? So key employee executive retain reward is probably one of the bigger areas we see. Key man as well, where instead of the client owning it and getting a bonus to them, where the business owns it and they put it on a key executive or sometimes even an owner of the plan, then the business themselves is the technical owner of that plan. And then they have these assets for liquidity down the road, and or if that key person would actually pass away. So it's a strong part of what we see here as business owners, as well as doing it for their employees.
Yeah, I mean, Kaizen gives you the triple advantage, right? You can do it personally. You can do the wealth transfer if you're a grandparent, a parent, want to leave something to kids, grandkids, whatever it may be. And then in the business setting, it gives you those dollars long term for income to retain employees, to keep the executives in line if they want to stay in the business. It gives them an added value to be there. Any other things that I'm missing that could be to go along with the Kaizen strategy?
No, just the main thing I think to promote, especially in businesses, remember, capital is king when you're the business owner, right?
Mm-hmm.
So the 5 payments, whether I'm doing it for my key employee or whether I'm doing it for myself, I can see that. It's not a 20 pay or a 2H65. I can stomach that better. I'm getting other people's money or utilizing other people's money, but I know those 5 payments are going to help. And even for individuals that are not maybe business owners per se, but that is one of the primary things to remember on that I think is the most important is I know going into it, I can budget for 5 payments going in, and I'm going to get roughly 3-to-1 leveraging on top of that.
So Jeremy, I really appreciate you being here today. The explanations on Kaizen were, spot on for what the strategies are. If people are out there and they're looking to learn more about the strategy, you can actually comment on this podcast. Say you want to learn about Kaizen, we can send you a personal invitation to their own site. It's called My Elia. You can get all the information, look through the policy, and actually experience what we're talking about here. But Jeremy, I really appreciate your explanation. It was great to hear it from someone who's been doing it for a long time. I'm a little bit not as high as you are in the expertise, but making it work for people that are looking for this type of planning. So I appreciate your time today.
Absolutely. Thank you for having me, Brendan. I appreciate it.
And enjoy your summer in Minnesota, pal.
I certainly will.
Thank you.